Let's talk a little bit about private credit, because maybe I watch too much Bloomberg News, but there's all this talk of, cockroaches. If you see one bad credit, there's a lot more that you haven't seen. But how do you see this booming private credit market?
A fraud is a fraud, right? So it can happen anywhere. It doesn't mean that there is a reservoir of fraud, lurking in the dark and jumping on you at the first occasion. Having said that, if we look at the data, the market is under stress in the sense that the default rate is very much in line with the historical default rate, with the proxy that we're using. So that's a very big caveat. We're not talking about direct lending, we're talking about leverage loans. But so the historical default rate is around 1%, and we're slightly above that, right? But if you look at liability management exercise, which is the whole, let's say, review of existing loans to try to adjust them without going into default, then we are much higher. We're around 4-ish%, whether in the US or in Europe. So it means that there is tension, but it's not illogical. These loans are under strain because the base interest rates are high, and the spreads are still significant. They have been compressing. We have read about that. So the loans are under stress. Now, bold statements are what they are. I won't comment on that, but it's not new that there is stress in the system. And the key question is, are we comfortable with extending, with reshuffling, with reviewing? Apparently, yes, because it happens. And the lenders, let's remember that the lenders themselves have to either deliver a track record to continue to raise money or to collect it, or in the case of leverage loans, to continue just to have a job. So there is a bit of discipline. And there is another fund manager who went on the record saying exactly that, saying, governance is a little bit different in the direct lending sector, because we are not just here to pass the bucket to someone else and structure loans. We actually hold them, and we have to live with them until the very end. So we eat our own food, right? So direct lending might not be completely superior, and it's not that you have a class of geniuses who only do direct lending, and then leverage loans and high yield bonds are done by very different people. They're all extremely smart. It's just that in one case, the idea is that should I do it knowing that I will have to live with it for 3, 4, 5, 6 years, and then what's going to happen if there is a problem?
Yeah.
There is also this idea that the longest, the fund managers who have the longest track record have also these recovery teams, and somehow they have been through the drill, right? In 2008, in 2020. And so the recovery rate is supposed to be higher than if you just do credits and then act like a credit holder when things are going well, but you're not necessarily equipped when things are going wrong. Another thing which we have to witness as well is that the nature of the collateral might change over time. So, for example, what we know is that direct lending is exposed at 1/3 to IT. So the question is what kind of collateral do we have here? Is there any asset? Is there any, let's say, in case of recovery, how much can we recover against a loan, for example? Because these are maybe asset-light firms. If they're not going well, what's the value of the company in case of exit or sale, whatever we want to call it. Whereas if you have like a traditional business with maybe some sort of machines, which have, that's also, so historical data is helpful in our industry, but we have always to put it a little bit in perspective.
Yeah.